This video is the first of 4 making options easy and understandable. Options are the best way to mitigate risk in the market and maximize returns. There is no doubt that using options has boosted my returns over the years. And the sad part is many retail investors still don't use them because they're taught in a manner that is overly complex and technical. However, options are really simple, powerful tools that all investors should be using. In this video, I'm going to break down the call option. I'm going to make it easy and understandable. And if you understand the value of a call option, then you can easily understand all other options.
This screen right here is where all the magic happens. This is where you do anything that you want to do with options. Buy them or sell them. It's all right here. So we are first going, and by the way, I'm in my Schwab account and the market is going to be open here in about 35 minutes. So you can see the price is kind of fluctuating. So right now I have up Amazon, strategy call, because we are going to buy a call option. When you buy a call option, you select buy to open. You're buying something. Remember, we are buying the right to lock in a price of a company or ETF for a certain period of time. That's what the call option is. So we have buy to open, quantity 1. That's one contract. One contract represents 100 underlying shares. You can see that Amazon is currently trading at almost $235 a share. And notice we have call up here. If we had put up here, we'd be buying the put. Because it's, again, if you want to buy a put, it would be buy to open. But we're not doing that. We're buying a call. So let's make sense of this. So here are the strike prices. You can't see them all on your screen, but I can go all the way down to like a 145 strike. And that would mean that I would choose, I'll click on it right now. That would mean that I am choosing to buy Amazon for 145 essentially one day from now, which makes no sense because when I'm recording this, it is January 22nd, 2026. But here are all the expiration dates. Now I have to have this window smaller because I don't want to show my actual account number and I don't know really how to blur it out, but you can get the idea. This tab here are all the dates you can pick. It goes all the way to December 15th, 2028. So we can lock in a price of Amazon for quite a long time because today's date is January 22nd, 2026. We can lock in a price to buy Amazon all the way up to December 15th, 2028. That's as far out as the time horizons go. But there's a bunch of different time horizons you can pick. And then here are the strike prices. You can pick a bunch of different strike prices. The highest strike price you can pick is $370. So you can lock in the right to buy Amazon at $370 a share up until December 15th, 2028. Now let's make sense of the value of the call option and how it's valued. So this is really easy to understand. I'm actually going to just pick a year time horizon. I can't go into all my options strategies in this lesson. That is going to take place on my channel as I show you what I'm actually doing in the markets and I'm showing you real trades and how they play out. What we're going to do is mess with different time horizons in this video and make sense of why an option might be more expensive to buy or less expensive. In general, when you want to lock in the price of something for a longer period of time, it will cost you more money, which should make sense. I coach, I do one-on-one stock market coaching, but I always like to put it like this to help you make sense of it. Let's imagine that I was going to buy your house. And let's imagine your house is currently, the fair market value right now today of your house is, let's just say $400,000. And I come to you and I say, hey, I want the right to buy your house, but not the obligation, right? I don't have to buy it, but I can. I want the right to buy it at $400,000 5 years from now. And I'll pay you some money. Imagine if I said, hey, I'll give you $1,000 right now if I can lock in that price. So now you can't sell your house to anybody else. You have to wait 5 years to see if I'm going to buy your house for $400,000. And I say, hey, I'll give you $1,000. You would likely say, no way. Because in 5 years' time, your house could be worth $600,000. So you might say, yeah, sure, pay me $50,000 right now, and then I'll give you the right to buy it at $400,000 5 years from now. You might do that. But you can see how it's logical. The longer you go to another investor and say, hey, I want to buy your shares at this price, the longer that they are committed to selling you their shares, the more money they're going to want because the shares could go up in value by a lot. So it's very logical. So I'm going to pick a time horizon of January 15th. That's about a year from now, 2027. And let's just look at a strike price of $300. So this means if I would buy this call option, that the fellow investor is agreeing to sell their shares at $300 up until January 15th, 2027. And the cost of that, if I would do this, if I would buy this call option, it would cost me $1,240. Now, what if, notice Amazon's trading at 234. It's not at 300 yet. But do you see how there's some value to this option? Someone is willing, the market, the supply and demand between all the option sellers and buyers has come to a price of $1,240. So there's value, obviously, in locking in the price of Amazon for a year at $300 a share. This value, let's fast forward now to expiration. Let's call it Expiration Friday. Options agreements, they expire on what is known as Expiration Friday. Let's now fast forward to January 15th, 2027. And let's imagine that Amazon's trading right here at 234. Well, we spent $1,200 essentially to buy this option. Would there be any value if we fast forward now to the Expiration Friday, would there be any value of saying, hey, I have the right to buy Amazon at 300, but it's currently trading at 234? Is there any value in that? Like, would anyone want to buy your option from you? No, they wouldn't, because they can just go to the open market and buy Amazon for 234. They're not going to go buying Amazon for $300. So there's no value in that. It is said to have expired worthless. There's no value in having the right to buy Amazon at 300 when it's currently trading at 234. There's absolutely no value in that. But now let's imagine that we fast forward to, again, January 15th, and let's imagine that Amazon's trading at $400 a share. Well, we have the right to buy Amazon for $300, but it's currently trading at $400. There's some value there, right? We have the right to buy 100 shares of Amazon for $100 less than it's currently trading at. And so what would you think that value would be? It would be $10,000. So if we fast forward to Expiration Friday, which is January 15, 2027, and Amazon is in fact trading at $400 a share, we could just sell the option for $10,000. Well, what if Amazon was trading at $350 a share come January 15, 2027? Is there value there? Well, the answer is yes. Amazon's currently trading at $350, but we can buy it at $300. So there's a $50 difference times 100 shares, because we have this is one contract representing 100 underlying shares. The option would be worth $5,000. That's how they're valued. Now notice though, in this particular option, notice Amazon is at 234. It's not at 300, but there's still some value here to this option. That's said to have time value, because there's a whole year left on the contract. Amazon is not trading at above 300. It's only trading at 234. So the value in this option is said to have all-time value. If an option has value and it has not yet, and that is if a call option has value and the stock is not yet past and above the strike price that is chosen, it's said to have all-time value. Now you have to understand, when you buy a call option, you are spending money to buy that time. Just like in the example of buying a house and locking in a price for 5 years. To lock it in for 5 years, someone's going to charge you money, a lot of money to lock it in for 5 years. Options have all intrinsic value, okay? That would be the example of, if we fast forward to Expiration Friday, where time is up, there's no more time left. If the option has value, it's said to have all intrinsic value, because as the contract plays out week over week, time value starts to decay. It goes to zero, which makes sense. And so options can have all-time value, like this one here has all-time value, because it's not yet above $300, but there's still a year left. So this option has value. It's got all-time value. Now, what if we pick a strike price of, let's just say, 200? Notice how it's going to cost a lot more money to buy this call option, because we're getting the right to buy Amazon for less than what it's currently trading at. So there's already value there. There's some intrinsic value. The intrinsic value is simply the amount the stock is above the strike price. That's intrinsic value. It is said to be in the money. Because obviously it's very logical that, hey, if we can buy something for 200, but it's currently trading at 235, let's say, well, there's value there. So this option, this amount of $5,345 is a combination of time value and intrinsic value. So let's figure this out. What would be the intrinsic value wrapped up in this 5,345 price? Well, it's simply the difference. We're going to say Amazon, let's just say for easy math, Amazon's trading at 235 right now. So it would be $35 above the strike price. So it has $35 of intrinsic value. So $3,500 of this 5,345 is intrinsic value, and the rest is time value. So you simply would just take the price of the option, 5,345, and you subtract 3,500. So this option, if we would buy this option, we're going to buy the right to lock in the price of Amazon for a year essentially. There's going to be $1,845 of time value tacked on to this value of the option. Now let's imagine that we fast forward now to, again, expiration Friday, January 15th, 2027. And let's imagine that Amazon's trading right at 235. Okay, let's just imagine. We bought this call option, which means we're bullish on Amazon. Like, we want Amazon to go up when you buy a call option. When you buy a call option, you want that stock to go up above that strike price, so it starts to gain intrinsic value. In this particular example, we're already buying one that has intrinsic value. So let's imagine we fast forward to January 15th, 2027, and Amazon, let's say, is trading at 235. Well, time is up. We have the right to buy Amazon at 200, but it's trading at 235. If we wanted to sell the call option and just sell it off and not take over the shares, what could we sell the option for? Well, the difference is $35. So it's $35 above the strike price times 100 shares. We could actually sell the call option for $3,500. Now, did we make any money on the trade? No. We bought the option for $5,345. The time value decayed off the option. That approximate $1,800 of time value gradually went to zero. So a lot of people don't like call options because they don't like to spend all that time value. Now let's look at another strike price. Let's look at a 235 strike. It's going to be less money. Why? Because this is basically all time value and there's no intrinsic value. The deeper you go in strike price, like say I pick a 180 strike, the more money it's going to be. Why? Because this option has more intrinsic value and there's still time value tacked onto it. So let's figure out for the 180 strike price, let's just figure out the intrinsic value that it currently has. If we buy this option for $6,745, so it'd be locking in the price to buy Amazon for $180 a share up until January 15, 2027. It has intrinsic value, and the intrinsic value is the amount the stock is above the strike price. So it's above the strike price. We'll say Amazon's trading at $235. It's above the strike price by $5,500. So to calculate the time value on this option, you simply would subtract the total amount that this thing's going to cost, $6,745. We'd simply subtract the $5,500 in intrinsic value. And so that option, this one here, has $1,245 in time value. So less time value is tacked on the deeper you pick in strike prices. So that's something that you're going to be aware of as we continue to talk about options. Now, a lot of investors just don't like to pay that time value. There's a reputation that call options are expensive. And I would agree. They are kind of expensive when you tack on the time value. Imagine if there was no time value on an option. Like let's imagine right now that let's imagine if we wanted to lock in the price of Amazon for $235 a share. Let's imagine it costs us like $10 to lock in the price of Amazon till January 15, 2027 for pretty much a year, and it costs us $10. That'd be like the biggest no-brainer trade. We'd fork over $10 to essentially kind of control or be in control of 100 shares of Amazon for a year. No person is going to just take $10 and say, yeah, you can buy my Amazon for $235 a year from now. No one would do that in their right mind because Amazon might be trading at $300 a year from now and they just lost out on a ton of appreciation of the stock price. So you can see how logical this is. If you pick a strike price, like let's pick a really high strike price, 370. Notice how it's cost barely any money. Well, not barely any, it's still $400. But think about this trade. Let me first ask you a question. In the value of this option, this $400, this has value right now. It does. There are people willing to pay $400 to buy Amazon for $370 a share up until January 15th, 2027. It's all time value because Amazon is not trading above the strike price. But could you imagine forking over $400 to buy Amazon for $370 a share a year from now? You already kind of intuitively know that that's probably not going to happen. It's low probability, right? And therefore, look, it costs $400. So the higher the strike price you pick above where the stock is currently trading at, the less you're going to have to pay, but the less probability it's actually going to reach that and get above that price. So let's look at a 235 strike and see what the cost is there. If we basically lock in the price of 235, which is where Amazon is currently trading at, it's going to cost us $3,375. Let me ask you a question. Is there any intrinsic value wrapped up in the cost of this call option? The answer is no. It's not trading above 235 yet. This is still all-time value. And that's a big chunk of money when you think about it. Let's, again, fast forward to January 15th, 2027. We are on expiration Friday. Time is up. Time is up. If Amazon is trading at 235 and we have the right to buy Amazon at 235, what would be the value of the call option if we wanted to just sell off the option and not buy the shares? It'd be worth nothing. There's no value in being able to buy Amazon for essentially what it's trading at. So all this time value decayed to zero, which happens gradually over the life of the contract. Now, let me ask another question. Where does Amazon have to get to essentially break even on this trade where the stock gets to a certain price on expiration Friday? We didn't make money, but we didn't lose money. What price would Amazon have to get to? It would have to get to around, and the way to do it, by the way, mathematically, was you just add the cost of the option to the strike price. So to make it simple, let's just pretend the option cost $3,500, which would be 35 a share. You simply just say 235 plus 35. Our break even would be Amazon getting to 270 a share. So Amazon's got to get above 270 a share for us to start making money on the trade. What if come expiration Friday, Amazon is trading, let's say we buy this call option for 235. Let's say on expiration Friday, Amazon is trading at 230 a share and we have the right to buy it at 235. Does the option have any value? No, the option has no value. There's no value in being able to buy something for a greater price than what's currently trading at. So when you buy a call option, it will expire worthless if it does not get above that strike price you chose, which makes sense. So this is all very easy. Now let's mess with some of the expiration dates. Let's keep the 235 up. The right to buy it at 235, we're locking that in. Let's say we're just going to lock it in up until June, so about 5.5 months from now. Notice, cost less money. Why? Less time. So to get a whole year, it's going to cost us that much. And then to buy it for about 5 months, to lock in the price for 5 months, costs us $2,000. So there's a theme here. The longer contract period, the longer you have to lock in a price of the stock for, where someone has to sell it to you at that price, the more it's going to cost you, and that is time value. So this really is the call option and how they're valued. And you can mess around with a bunch of different strike prices and expiration dates, but you'll see the pattern. The longer you can lock in the price of a stock for, the more you're going to have to pay in time value. What if we did it for almost just basically a month? Let's say we locked it in, we have the right to buy Amazon at $255 and it's currently trading at $235 and it's essentially a month from now. It will cost us $340. Now you have to think about this. I want to ask you some questions. Would you really want to buy this call option here for $340 where Amazon only has 1 month essentially to get above $255? No, you probably wouldn't. It's just low probability. Let's see if we can pick a 300 strike. We'll go 295. Yeah, you can barely get any money because no investor in their right mind is going to buy the right to lock in the price of Amazon for 295 when it only has essentially a month. Some investor out there is willing to pay $32 apparently. So you can see that the shorter duration you pay less time value, but it makes sense because the chances it's going to get above that strike price in that 1 month is low probability. And this is basically how the call option is valued. Let's talk. I don't really buy call options anymore because I don't like to spend money on time value, but let's talk about the advantages of buying a call option versus actually buying the shares of the stock. So let's imagine that we're going to do the 235 strike and we're going to do it up in, let's just say, a year. It's going to cost us about $3,300, and that is all time value. And so what would be the advantage of this, of doing a trade like this? In a sense, you are leveraging a little bit. You're getting to essentially control, let's say $23,000 of stock for a smaller price of $3,300. So you're kind of levered a little bit. But also, you're protected too, because let's say you buy a call option on a risky stock and you don't want to go outright buy that stock. Let's say it's a pharmaceutical company or a biotech company, and you don't want to buy and own the stock for, let's just imagine the stock is trading at 100, say 100 shares is $100,000, but it's a risky stock. And if you would actually dole out $100,000 and the stock dropped 50% because, say, a drug didn't pass, well, then you have a paper loss of $50,000. Whereas you could just buy the call option on it, and if the stock plummets, you only lose the price of the call option. So the call option actually represents capped downside. You can only lose the amount of the call option. That's all you can lose. So it's capped downside, and it's said to have unlimited upside. So there's actually asymmetry to a call option. And that's why certain investors like call options. I don't buy call options anymore. It's rare that I'll do it. I'll do it occasionally. But again, I'm not a fan of paying all this time value, because then Amazon, like we said, has to get to around, whatever that number I said, 270 a share to break even if we buy this call option. So let's run through one more example to see if you are catching on to the value of the option. Let's say we lock in the price to buy Amazon at $200 a share up until November 20th, 2026. It's going to cost us $5,180. What is the intrinsic value of this option currently? It's $3,500. The intrinsic value, again, is dollar for dollar how much it is above the strike price. But then notice there's still several months on this option. So it costs more than $3,500. It actually costs $5,180. And to learn about the time value tacked onto this option, or to understand what the time value is in this option, you simply subtract 5180 and you subtract the $3,500 in intrinsic value. So there's $1,680 of time value wrapped into this option. So that's it. That's the call option. When you want to buy a call option, you click buy to open. This is one contract that represents 100 underlying shares. You have the ticker symbol up. You pick your expiration date, and you pick your strike price. And that's it. That's the call option. And again, on expiration Friday, if the call option has any value at all, it's only intrinsic value, which means the stock went above the strike price we chose. If on expiration Friday, the call option expires worthless, that means that it did not get above the strike price. Even if it's trading right at the strike price we chose, we lost time value. We lost the money and time value that we paid for. So that is the call option. Very simple to understand.
When you understand the call option and how it's valued, you are going to understand how all options work. In the next video, I want to talk about writing a covered call. And so we are now going to look at it through the eyes of selling a call option to somebody else. You don't want to miss it, and I hope to see you there.